Hello there, welcome back to another video on investing on the stock market. Today I'm doing a boring fundamental video and I'm talking about how to keep risk under control, and it's very important. Now, before I start going into the things you can do to reduce risk, I have to say that less risk is not necessarily better. And if you don't take any risks, you're not going to gain anything. No risk, no reward. But you want to keep risk to a healthy level. So you want a combination of risky and less risky investments. So in your stock portfolio, the first thing you do to control risk is to diversify. So spread your money out between different investments. So don't put all your money in one stock. Buy stocks of different risk levels. So for example, some growth stocks, some dividend stocks. Invest in different countries and in different industries. Now, you don't have to, I think it's okay to have all your money in the US or, all your money in, growth stocks, but at least try and spread your money out between different stocks. But regardless of the risk of the stock, the most important thing is to find fundamentally strong and growing companies. That's the number one thing in investing. If you don't do that, you're not going to make money no matter what sort of risk you take on. And that also lowers your risk. Doing research, finding strong companies will lower your risk and increase the chance of success. And of course, you can also buy index funds and ETFs. So these are baskets of stocks where you get 1,000 stocks instead of one. So this is the ultimate diversification tool. I'm not a fan of buying funds. I want to pick what companies I give my money to, but this is a way to just automatically diversify. So big funds would be like VUIM or SCHB. Those are like the two main ones for me in the US anyways. You can try and find dividend stocks. Dividend stocks tend to be safer. They pay you guaranteed interest on your money, so it's going to come no matter whether the market is up or down. So this helps to smooth out the curve and give you less fluctuations. And of course, if the stock market is down 10%, you're still going to get 3% dividend, so you only lose 7%. So it is not a hedge, but it helps to keep the risk under control. And dividend companies tend to be safer than growth companies. No, not necessarily better, but safer. Now, dividend stocks tend to be more defensive, but there are some pure defensive stocks. So what I mean by defensive stocks are companies that don't rely on big growth or big good news to keep growing. They are companies that just trickles along. They just keep making money no matter what happens. They sell things that everyone need. We will always need them. They are big companies. They operate over the whole world. They have a very stable balance sheet. They grow very slowly, but they just keep moving no matter what. Very few big swings. So stocks like that could be Johnson & Johnson, JP Morgan, Walmart stores, Waste Management. These are companies that will never move all that much. They're banking, healthcare, food, waste management, just stuff we'll always need. So these are considered defensive stocks. They can go along with some growth stocks, for example. And the fundamental approach that will help you control risk is investing for the long term. Don't be a trader, don't be a swing trader, just buy and hold, because that will means you invest without too many emotions. Emotions are generally a bad thing and will increase the risk of you doing something stupid. And stocks will also do well over the long run. You will get less costs and you will be paid more in dividends. So it's just a win. So invest for the long term. That helps control your risk, and it's just the best thing to do statistically and whichever way you look at it. And the last thing is a bit quirky one, but this is in extreme cases. There are income investments, which are pure dividend plays, like REITs, which is real estate investment trusts, and income funds. There are many out there. I know Wells Fargo have an income opportunity fund. There's a bunch of REITs out there. And their goal is basically to take all the money they make and give to investors. So it's a pure cash flow play. The price doesn't move much at all. It just pays a dividend. So for example, this income fund from Wells Fargo pays 1% every month almost. So it's 10% a year. The price aims to stay the exact same but just pay a dividend. So there are some extreme cases where investments don't really move, they just pay you some dividend. So these are some of the tools you can use to control risk, but remember, no, don't remember, but in my opinion, you should have high risk. I think risk pays off. I think growth stocks have always been the best. All my best performing stocks have been growth stocks, and the dividend and defensive stocks I have will never catch up to the growth stocks, no matter how much dividend they pay or how little they go down. So you need a healthy level of risk, but don't go too far in either direction. So that's the way I look at it. Good luck investing, and I'll see you guys in my next video.